First, let's talk about what's currently propping up the rally, because we know it started with tech and started to broaden it out. But where are we now in the rally?
Yeah, it's great to be here, Rachelle. Thank you for having me. It's a very interesting, dynamic that's going on in the markets right now, where a lot of people are feeling a little bit of FOMO because if they haven't been investing in this market, they've been missing out on a lot. So some of the things that we have seen are unprecedented in a sense, where 10 or so companies are making up, 35% of the return in the S&P 500. And this is what we're seeing, these bigger names, these heavier names, the tech names carrying the indices. And that's something that we want to think about and just provide a little bit of caution for our clients. If you are in the large names that have had quite a rally, it's not a bad time to pull back. And those are the sort of the things we're thinking about with clients, what to do in this market and how to best protect what they have and also help continue to grow to keep up with the pace of inflation.
And we do know that FOMO can sometimes overtake discipline, as you mentioned, when you see that you perhaps have missed a bit of the window in the rally here. But what risks should investors be keeping in mind if they're trying to jump into the rally right now?
Yeah, well, first of all, the markets are up pretty tremendously at the moment. And a lot of that is being driven by things that aren't traditionally what is driving the market. So basically with the COVID recovery and all of the cash in the market, we've got a tremendous amount of liquidity in the market, a tremendous amount of cash that is available for investing in the market, for spending and so forth. Right now, the rates are so high that a lot of clients are hanging on to cash and getting like a nice coupon payment back just by waiting. We're a little concerned about that in the long term because eventually rates are going to start to pull down. We don't think it will be for a while, but when they do, you will start to be hurt in a sense that you haven't taken out your duration a little bit longer. So we are encouraging clients to think about taking some of that cash or some of the money that's sitting on the sidelines and putting it into a little bit longer duration, fixed income, quality companies.
And so when people are thinking about this rebalancing that they should be doing, what should be on their checklist when they're thinking of what they should be rotating in and out of and how to not really chase the rally, but really still focus on the fundamentals?
Absolutely. And fundamentals is the key. So basically, value companies it can be boring, but they can also be very protective. And also, if you have the dividends giving you a little bit income as you're waiting for those companies to grow. Also, growth at a reasonable price, we like a lot. So a lot of these companies, if you look at their growth, they've been tremendous. But is the price reasonable? Is the PE reasonable? It's very expensive right now to own some of these companies. So peel back if you have them, peel back now and put that money into more reasonably priced companies. And we also will say that a real bull market is going to run with new winners and new leaders. Right now, we're not seeing that quite yet. So we're just advising our clients to be a little bit more patient and to be thoughtful about where they invest. And maybe some areas like financials and some like consumer discretionary, some healthcare, energy, materials. Those are areas that we think should do well going forward.
And you did note some of the economic indicators, including things like rising credit stress, that are also still plaguing the markets at the moment. So, as you mentioned there, in order for you to believe that this rally is real, a bull market is real, what would you need to see happen with those indicators to say, yes, this is where it is from now?
Yeah, well, in actuality, the last like six bear markets has had quite a run towards the end, and then a big pullback and almost retest the bottom. So, if you've made a lot of profits in companies or growth in companies right now, there's no need to test those bottoms. Like that's why we're saying peel off now. Things that we want to think about too are the service industry is an area that has really kept the markets going, and the consumer has been spending. Now, this was a lot of the things that they're spending on happened a year or so ago. And the question is, will they continue to spend? Their real wage, income is not as high as it was a year ago. Interest rates are much higher, credit's higher, and we're going to look at their credit cards and the balance is there too to see what kind of stress is there. In terms of corporations, we also think that they've been favored because the consumer has been spending, but we have to watch that and see if that's going to change their dynamics as well.